All right, ladies and gentlemen, we're going to look at chapter 18. So we're continuing our unit on credit, and we're going to look at using credit wisely and then the cost of credit. So it's important that you use credit wisely in your life to further your financial position, make sure that you're not putting yourself in harm's way. So we want to look at the responsibilities of consumer credit, how to protect your credit from fraud, and then how you can reduce or avoid credit costs. So you have responsibilities not only to yourself, but also to creditors, and then creditors also have responsibilities to you. And so it's important to understand and know those responsibilities before you jump into sort of experimenting with credit or using credit in your life. Responsibilities to yourself. You want to use credit wisely and not get into debt beyond an amount that you can comfortably repay. Essentially, when you're taking out credit, you are incurring debt because somebody's giving you money that you have to pay back. But you can do it in such a way that you know you can pay back that debt and you can use credit to your advantage. So you want to check out businesses before making credit purchases. That's another responsibility to yourself to make sure that you are making wise decisions about who you're borrowing from. You want to comparison shop. You want to avoid impulse buying. So comparison shopping involves checking different places to make sure you're getting the best price for equal quality. This is just kind of basics of any kind of shopping, but you really want to do that when you're thinking about credit. And then impulse buying is when you buy something without thinking about it and really making a conscious decision about it. And you really want to be careful about that because that can lead to serious debt that you can't always dig yourself out of if you're just somebody who's prone to impulse buying. You want to have the right attitude about using credit too. So when you enter into a transaction with credit, you want to do it with good faith and full expectation that you can meet those obligations. In other words, if there's doubt in your mind about whether or not you can repay the debt that you're incurring, then you're not really acting in good faith and you don't have full expectation of meeting those requirements, and therefore you should not do it. Garnishment is something that happens when you don't have when you're not upholding your end of the bargain. So that's basically that's when part of your paycheck is withheld for payment of a debt. So you can get yourself in a situation where you took on a bunch of debt, you can't pay it, and now companies are garnishing your wages. They're taking money out of your paycheck because you owe them. When you open an account, so looking at responsibilities, not just to yourself, but to creditors, you're pledging that you're going to be honest and sincere in your use of the credit. So you want to follow through on that by limiting your spending, by making payments regularly, by understanding the terms of the agreement, by contacting the creditor to resolve problems. So these are all things that you can do and are things you should do as responsibility to your credit. Creditors also have responsibilities to you. So they are supposed to help you, assist you in making wise purchases, inform you about everything, all the rules, regulations, etc., cooperating with established credit reporting agencies, establishing and adhering to good, sound lending and credit policies, and then using reasonable methods of contacting you if you fail to meet their obligations. You want to think, too, about protecting yourself from credit card fraud, because this fraud costs businesses and consumers millions of dollars every year. And there's a lot of types of fraud, but the main ones are using a lost or stolen credit card and illegal use of credit card information that was been intercepted online. So while the credit card holder's liability is limited to $50, the merchant is not protected from losses. So what that means is, let's say somebody uses a stolen credit card to buy something. You're protected, but the merchant, the store, is not protected from it. And so typically stores will charge additional fees when using credit cards to kind of cover those types of losses. So a couple ways to safeguard your credit cards. You want to sign and activate your cards immediately. So on the back of credit cards, there'll be a place for you to sign it. That's an important thing for you to do. You want to carry only the cards you need when you're going somewhere. Keep a list of the cards and information about them in a safe place. If your credit card is lost or stolen, you want to notify the creditor right away. You want to watch your card during transactions. So make sure that the person handling your card is doing it in a way that is discreet and that you can tell is not maybe stealing your information. And when you are finished with old receipts, you want to tear them up so that people can't get your credit information. Continuing, you don't want to lend cards or leave them lying around. So don't lend your credit card to somebody that you don't trust. When your cards expire, cut them up, destroy them. Don't give credit card information to people or businesses that you don't know, and keeping receipts and verifying charges on those statements. So you want to make sure that the statements match what you have done. And then online, you want to make sure that you are dealing with companies that you trust. Look for secure site symbols. So there's an encryption code that protects your information. And when it's encrypted, it's unreadable to others. You want to review your privacy policy to make sure that they are protecting you and your interests. You could look for a seal of a nonprofit watchdog group online. Make sure that you're initiating all transactions yourself at sites that you trust. So you want to be careful of phishing. This is a scam that uses these pop-up messages or emails to deceive you into disclosing personal information. So this can be done now today through Facebook message or through Instagram or through email or through pop-ups on websites. And they'll send you messages that appear to be legit from a business that you deal with, but is not. So like, for instance, even in the last couple of weeks, I've gotten a few from PayPal. I've gotten a few from Netflix, in quotes, PayPal, Netflix. They're not real, but they can appear real at first. But you have to really be careful. If you're getting an email or a message from a company, even if it's a company you know, you want to really examine it and look at it closely, because it sometimes can be a phishing scam. In general, you don't want to have a bunch of unnecessary credit cards. If you have credit that's unused, so let's say you take out 5 credit cards and you're really only using 1 every month, that means you've got 4 credit cards that are full of unused credit. So maybe each of those is a $10,000 credit limit. That means you have $40,000 of unused credit, and that actually hurts your credit score. So if creditors are looking at you saying, oh, they've got all this credit, but they're not really using it, then why would they loan to you? Because the way they make money is for you to use credit and then pay it back. So you don't want to you don't want to do that. You want to also consider making more than the minimum payment. So if you're only making the minimum payment on a credit card, you're actually not paying off the balance of your payment. You're just paying off enough so that you don't have to incur interest. But that can quickly add up and you can get behind on your payments, and then that's bad. So you want to always pay off your balance each month, not just the minimum payment. Don't increase your spending as your income increases. This is a hard thing to do, but it's a good way to avoid unnecessary credit costs. So just because you maybe get a raise and start making more money, you should not start then spending a ton of more money. You want to keep your credit accounts to a minimum, and you want to pay cash for small purchases for the most part, or maybe use a debit card. You want to understand the cost of your credit. You want to shop around for loans as well. And then this is a big thing, this last one. And I would say, personal Mr. Fisher advice. If you're using a credit card, it should really just be because of rewards and incentives. So most credit cards offer some kind of rewards program or a rebate plan or something. So for instance, if you have a credit card that might offer 3% cash back on grocery purchases, or 2% cash back on gas, or something like that. Or maybe it's a travel card and you get points for travel. So typically in my opinion, the best way to do it is say, I'm going to use my credit card to pay for things that I know I already have the money for, that I could pay cash for. So let's say you go to the grocery store and you buy $100 worth of groceries. In my account I have $100. So what you could do is pay for those groceries and give them a $100 bill. That's great. But if you use a credit card, okay, I'm using this credit card to pay $100 that I know I already have, but I'm getting 3% cash back on that. So I'm earning $3 of rewards every time I do this. And then at the end of the month, I'll just pay off my credit card bill with the $100 I already have. And then that way you're getting rewards. And I think that's the best way to do it. If you're using credit cards as a way to pay for things that you don't have the money for, that's bad. If you're using a credit card as a way to pay for something that you already have the money for, but you're getting an additional added reward, then I think that's a great way to do it. Okay, we're just going to quickly look at the cost of credit. Why does credit, let's see here. Why do credit costs vary? And then some simple formulas for a few different things. Credit costs vary for different reasons. There's different sources of credit. There's a different amount financed and the length of time. So there could be short-term credit and long-term credit. There's your ability to repay the debt. There's collateral. There's interest times. Prime rate's the interest rate that banks offer to their best business customers, like large corporations. But then individuals tend to have higher rates because the risk is greater to the lender. There's also economic conditions. So right now, interest rates are actually really low for the most part for different types of credit because the economy is struggling. And so they're trying to incentivize people to take out loans and use credit and things like that. Fixed rate loans are loans where the interest rate doesn't change. So let's say you buy a house and you get a fixed rate loan of 3.5% interest. That means for the entire life of your loan, which for most mortgages are 30 years, you know you're going to be paying 3.5%. Then there's variable rate loans where interest rate goes up and down according to inflation and other economic factors. That can be useful in some cases, but in most cases, if you can get a relatively low fixed rate loan, it's much better than getting a variable rate loan because you just don't know what's going to happen with that rate. There's a few different ways to compute the cost of credit. There's a simple interest formula, and then there's an APR formula. Simple interest is computed only on the borrowing amount without compounding. So a simple interest formula takes one payment at the end of the loan period and base interest on that. It's based on the principal of the amount. So that's the amount borrowed. And then the rate is the percentage of interest you will pay on the loan. And then the time is the period during which you will repay the loan. So if you look at it in terms of formula, it's interest equals principal times rate times time. The APR formula, there's two different ways. There's a formula and there's tables. So APR tables are more precise, but the formula sort of just approximates the APR. I'm not going to spend too much time on this, but you can look in the book. Some of your questions for the AQ this week will be based on some of these formulas. So the N is the number of payment periods in a year. The F is finance charge, and then the P is principal. The N is total number of payments. Capital N is total number of payments. I know that this isn't really showing up well, but take a look in the book and it'll show you more. And then a down payment is an installment that sometimes contracts require a down payment, which is part of a purchase upfront in cash. And then the down payment reduces the amount of the loan. So let's say you're going to buy a car and the car is a $20,000 car. If you can put down $10,000, then obviously instead of you having a $20,000 loan, you will have a $10,000 loan. It also makes creditors more likely to give you a loan if you have money that you can put down upfront, because that tells them that you are responsible, that you are good at saving, and that you are probably a reliable source to give credit to. Okay, so that's it for chapter 18.